All right, let's talk about something you've probably seen a million times, the expense ratio. It's one of those investing terms that sounds way more complicated than it actually is. So today, we're going to break it all down with a really simple analogy that makes it all click. Your gym membership. Let's dive in.
So, first things first. When you see this term on a mutual fund document, what does it actually mean for your money? What are you really paying for?
Honestly, it's this simple. The expense ratio is just the annual fee you pay to a fund for managing your investment. Think about it. You pay a fee to use a gym's equipment and facilities, right? Well, it's the exact same idea here. You're paying for their expertise and for them to manage the whole thing for you.
Now, to really get this, let's start by picturing a super high-end luxury gym. We're going to call this our luxury gym fund. You know the type of place I'm talking about, right? It's got personal trainers walking around, dietitians on call, a million different group classes, the AC is always blasting, and of course, they have that fancy lemon water waiting for you. It's the full-service, premium experience.
And this is a perfect parallel for an active mutual fund. It also offers a premium service. You've got a dedicated fund manager, whole teams of researchers digging deep, and constant monitoring of the market. Their goal? To pick winning stocks and beat everybody else.
And well, here's the catch, and it's a pretty simple one. All those premium services, whether it's at the gym or in your fund, they're not free. More hands-on management, more resources, it all means a higher membership fee, or in our case, a higher expense ratio.
I love this quote because it just hits the nail on the head. It really highlights the risk, right? If you're paying a premium but not actually getting better results, you're basically paying for a swimming pool you don't even know how to use.
Okay, let's flip the script. Let's go to the complete opposite end of the spectrum. The economy gym fund. This is the no-frills, get-it-done approach.
And you definitely know this place too. There are no trainers, the showers are, well, they're functional. There's always that one treadmill that makes a funny noise, and the dumbbells look like they've been collected over the last 30 years. It's not exactly glamorous.
But you know what? It has everything you actually need to get in a great workout. It gives you the essential tools, and for a ton of people, that is more than enough to hit their goals.
And this is the perfect stand-in for a passive or an index fund. See, these funds aren't trying to be Wall Street geniuses. Their job is much, much simpler. They just copy a major market index like the Nifty 50 or the Sensex. Because they're not trying to beat the market, their costs are kept super low.
And that leads to their biggest advantage. That no-frills automated approach means the fees, that expense ratio, are incredibly low. And this is the part that can make a huge difference over time. A difference of just 1% in fees might not sound like a lot, but over 20 or 30 years, that tiny little leak can compound into a massive hole in your final portfolio. That's the real magic of keeping fees low.
So now we've got our two gym types, our two fund types. Let's put them side by side to really see how they stack up against each other. So here's the breakdown. The active fund is our luxury gym. You're paying a high expense ratio for those premium services, like dedicated research teams. And then you have the index fund, our economy gym, a very, very low expense ratio for a super straightforward service that just follows the index.
At the end of the day, the choice really is yours. I mean, you'd pick a gym that fits your fitness goals and your budget, right? It's the exact same thing here. You should choose a fund that actually aligns with your financial goals and what you're willing to pay for.
All right, let's wrap this up. Time for the most important points to remember. Think of these as your final reps at the gym, the ones that really lock in the gains.
First, the big one. From now on, whenever you see expense ratio, I just want you to think gym membership fee. It's the annual cost to be a part of that fund strategy. Simple as that. Second, remember the trade-off. A fund that's offering more hands-on, active management is almost always going to charge you a higher fee. You're paying for that extra effort. And third, think of index funds as that chill, no-frills gym. They're simple, they're cheap, and honestly, they are a fantastic starting point for so many investors because you get broad exposure to the market at a rock-bottom price. And that brings us to the final question, which is all about you. Now that you get the difference, which financial workout really fits your style? Are you on Team Luxury Gym, hoping for that expert-driven performance? Or are you on Team Economy Gym, happy to just grow with the market for a minimal fee? The right answer? Well, it depends entirely on your own goals.